well, you don't have to be an LLC in order to be in order to write things off. Even if you're just a sole proprietorship, you get the same exact sort of deductions. However, the LLC, which is a limited liability company, so a lot of people like to call it a corporation, but it's actually a company. It's actually a state-run, or not state, it's a state entity that's set up, through the state, and you then have to tell the IRS what your tax designation is, whether you're going to be an S corp or a C corp. And if you don't do any designation, then you're automatically taxed as a sole proprietorship, where the sole proprietorship and even like a partnership, then a single member LLC, you're taxed 100% on your profit for Social Security and Medicare tax. But with an S corp, you actually get to divide that income into W-2 wages, which are subject to Social Security and Medicare, and then also distributions, which are not subject to Social Security and Medicare. So really, there's a federal tax savings there, but you have to realize in some states it might not be beneficial. So like I'm in Tennessee, and they don't recognize S corporations, and so they're taxed just like C corps, and there's a 6.5% tax, and that can wipe out any sort of tax savings, especially if you're over the Social Security wage amount. So and then there's C corporations, which obviously get double taxed, so they're taxed at the corporate level, and then when you want to take money out as dividends, it's taxed at ordinary, or dividend tax rates. So really, that entity selection is crucial, and majority of the time, S corp is going to end up being your best bet, but it really depends on how much you're making. So hopefully, you'll be able to kind of do some calculations to see what might end up saving you more, depending on what your reasonable salary is, or if you work with a tax professional, they can definitely help you out with that as well. So hopefully you guys are writing in your questions about entity selection, and I guess we'll tackle that after this talk. But definitely my second favorite strategy is retirement. It is definitely a low-hanging fruit, and it's a way for you to put build your wealth, put money aside, especially as physicians. We're I wanted to mention too that my husband is a physician, so when you go from that very meager resident income, then you go to an attending income or private practice. Retirement is one of the best ways to sock money away, especially when you're young, and have that tax-free growth. And then what a lot of my clients like to do, and what I find a lot of physicians do, is you guys are going to go and retire, or start at least slowing down by like late 50s, early 60s. And so you have a good 10-year or so period before you're required to take out retirement contributions, or take retirement distributions, excuse me. So that's the time when you can start doing Roth conversions, and then that money can be growing tax-free and come out tax-free at that point as well. So, I know there are a lot of people out there that have heard about the backdoor Roth, which is a really great way to not necessarily save tax in that current year, because you're putting money in as post-tax dollars. But what you're able to do is put that money into the Roth, let it grow tax-free. It comes out tax-free, but you have to just realize that if you make too much, then you need to do it the backdoor way. And if let's say that that's obviously an individual retirement account, and if you have your own business, then you can set up a solo 401k or a defined benefit plan to really go and increase your retirement savings, and thus be able to save tax, because those are pre-tax deductions. and the reason why I brought up the backdoor Roth was because a lot of people are like, oh, should I do a SEP IRA or should I do a solo 401k? Well, with the SEP IRA, you're not able to do tax-free Roth contributions. So you need to go and Roth conversions, excuse me. So what we need to do is keep you in a 401k that doesn't have that same limitation in terms of pro rata rules. So I hardly ever recommend a SEP. The only time that I recommend it is if I have a client that comes to me after December 31st and they want to make a retirement contribution, then I'll say, hey, let's open up that SEP, let you make that retirement contribution based off your 1099 income. And then, we can go and set up the solo 401k and roll over into roll over that SEP IRA into the 401k. By far, my specialties come with retirement. And also, that multi-state taxation, and especially with the retirement, there's so many intricate details between the different types of retirement plans, and especially too, let's say the practice that has employees, you have to offer those employees that same plan. So there are so many different hoops that you have to essentially get through in order to make sure you're doing it properly. Third, one of my ultimate favorite tax planning strategies are hiring your kids through your practice. It's an amazing way to shift income to their lower tax bracket. And this allows you to save for their retirement. You can put that money right into a Roth IRA. You're able to, put that money just into savings for school or tuition. And you're also able to, put it into, just use it for after school activities. So basically it's, again, a way for you to get a deduction for them working for you. The court tested age is 7. There are a lot of people out there that are like, hey, my kids are models for my website or something along those lines. Yes, but nowadays with iPhones and it's so easy for you to take pictures, unless your child is going and, doing other modeling gigs, it's more difficult to justify let's say $6,000 salary just based off of modeling. And I say $6,000 because that's the contribution limit for Roth IRAs. So that's something to be aware of in terms of the court tested age is 7. And you can go to my website as well. If you just Google kids jobs, Cerebral tax advisors, a blog post should pop up showing different types of jobs that your kids can do in your practice, or you just sometimes have to get creative depending upon their age and their skill set. Another really great strategy is called the Augusta Rule, and this was named after the golf tour, the Masters in Augusta, Georgia. There would be people that rent out their homes for 14 days or less, basically the 2 weeks that the Masters are there. And the IRS says, well, you don't have to pay tax on that rental income if it's done for 14 days or less in your personal residence. Now you're thinking, well, how does this apply for business people? Well, what you can do is apply it to your business, as your business can rent your personal residence, and for 14 days or less. It does not have to be consecutive, so it can be 1 day a month for like a monthly corporate meeting, and you're able to go and take a deduction for the business for that rent. It has to be reasonable rent, and but then you as the individual do not have to pay tax on that income. So it's an extra way that if you're already maybe for having company parties, or again those corporate meetings for yourself, then that's an extra deduction you're able to do. One thing you should also be aware of as well when it comes to deductions and credits and things that you're taking as business deductions, you really want to make sure you have proper documentation. And this is one of the items that I see people making the biggest mistake on, and that the IRS loves to nab you on. You have to save receipts. Credit card statements, bank statements, they do not count. The IRS cannot see what you purchase. So if you go to Staples and you buy a bunch of candy, or if you buy a bunch of, office paper, the IRS can't tell the difference based off of your credit card statement. So you need to make sure that you're saving those receipts, and you don't have to keep paper receipts. Take a picture. There's so many different types of apps out there. If you use QuickBooks Online, their app allows you to, like, they actually scan it, and like they can pick up the date and the place that it is, and it pops it right into there. It's really quite nifty. And then there's other ones like Expensify, or even if you just put it into Google Drive or Dropbox, and it makes it so much easier nowadays. And again, digital receipts count for that documentation. But yeah, what sort of questions do we have, Jordan? I know I just spit out a lot.
Let me unmute here. Yeah, so we have from John asking about cash balance plans, which is, I know, something that you know a lot about because we've talked a lot about it. And you kind of went into, SEP IRA and solo 401k, but maybe you can talk a little bit about the cash balance plans available for, someone. It could be a side gig. It would have to be, making a decent amount of money, but really for practices is where it comes in.
Yes. So you can actually start a cash balance plan with as little of about, $50,000, $60,000 of gross revenue. The way that it's calculated is through an actuary. So what they take into account is the, how much you make, so your compensation, and then your age, whether you have employees, and then, a few other factors. But in general, what happens is you need to keep that open for about you have to keep it open for 5 years and fund it for a minimum of 3 years. And what's great about it is you're usually able to put in a ton more than you would with just a 401k by itself. So with the 401k, the basic calculation is about 20% or 20 or 25%, depending upon the entity, of your compensation, or profit, depending again on the entity. But with if you're, let's say like 35 or 40, it's easy for you to put away about $75,000, $100,000 a year into retirement, where with the solo 401k, you're limited to that 20% or 60, this year it's $61,000, whichever is less. So, you'll need to, be aware if you want to put more away, you can. But there's also additional planning involved as well, depending on the type of entity that you're in. So even with that 50, 60,000, what you do is you put away, let's say $100,000 of retirement, that ends up creating a loss. And then that loss can be deducted against your ordinary income. So like your W-2 wages if needed. And you just have to fund it from W-2 wages in a nutshell.
And then the cash balance plan, that it's sort of handled by a third party, correct?
Correct. Yep. Yeah. So with unlike a solo 401k, just by itself, if you have the 401k and the cash balance plan together, then or just a cash balance plan by itself, you have to use actuaries or a third party administrator to actually create the plan and to administer the plan for you. Now, a lot of people are like, oh, well, there's extra costs. Yes, it's a more expensive type of plan, but the benefits greatly outweigh the cost in terms of tax savings. And so that's why it's important, though, to run the numbers and make sure that there's a good cost benefit there.
Awesome. So we have a question from Vinay. Does the SEP contribution have to be the same year as the backdoor Roth to prevent the contribution or any SEP IRA account precludes contribution.
So I think I understand the question, but
Yeah, and
basically,
if we need to clarify, Vinay, feel free to jump on.
okay. But yeah, basically, if you have any type of pre-tax IRA open, that includes an individual IRA, a simple IRA, a SEP IRA, then you have to make sure that that balance is zero by the end of the year. So by December 31st, in order to avoid those pro rata rules, to make sure that your backdoor Roth is a tax-free conversion. Otherwise, what the IRS says is that they look at your entire pre-tax IRA and even post-tax IRA and say, well, hey, if you're putting over, $6,000 post-tax, we can't tell that it's post-tax in that account. So they take a pro rata amount, and then you're going to be taxed again on a portion of it.
Yeah, and he just clarified. He said he has a SEP IRA from years ago. Does that prevent him from contributing to the backdoor Roth? And
It doesn't prevent.
You'd be subject to the pro rata. Yeah.
Exactly. It doesn't prevent you from doing it, but part of it will be taxable, and then you're taxed twice on it. So what I recommend doing is, if you still have a business, what you can do is set up a 401k. Actually, you can even potentially set it up now and then roll over that SEP into the 401k, because the 401k is not subject to those same pro rata rules.
Right. And then we have another question, but I want to kind of lead into it. We talked a lot about, S Corp, C Corp, these sort of plans available for people in private practice or for their side gigs, basically anything but W-2 income. What is, just really simply, because, I'm a W-2 physician, what do W-2 physicians need to make sure they're doing to reduce their tax burden? And this is a question Sarah Young just asked as well. But what are the kind of, no-brainer reflex things that we have to make sure that we're doing?
Yeah, definitely maxing out retirement that's available to you, especially if there's any sort of match. I mean, to be blunt, you're a fool if you're not contributing at least up to the match and getting that free money. And then if you are eligible for an HSA, you have that high deductible plan, and you can do that HSA, then HSAs are, and that's a health savings account, by the way, then they're amazing, because that money goes in tax-free, grows tax-free, and then comes out tax-free when you use it for qualified medical expenses. And so that's really a great way to do that. And then also too, making sure that you understand your employer's reimbursement policy for expenses, because a lot of times, people aren't aware that, that extra CE trip that they take, or, their dues and their subscriptions, that are needed in order to maintain your licensing, can be reimbursed by your employer. So being very familiar with their accountable plan or any sort of reimbursement plan can be very beneficial.
Yeah, I think definitely that accountable plan, that was something that I didn't have a good grasp on before, and then this past year with you was able to take advantage of. And then for the HSA first, before we go to the next question, because I know this is something that took me a while to wrap my head around. So you said, money goes in tax-free, it grows tax-free, it comes out tax-free when you spend it on health expenses.
Correct.
So initially I was kind of like, well, what's the big deal? Like I'm spending it on health expenses, so it's not like it's doing something to really help me. But you can, number one, I guess it is deferring taxes, so it's lowering your taxable income. But then you can also, you don't need to spend that money as the health expenses come up, correct?
You got it. Yep. So I like to actually use it almost like another retirement account. So what you do is you save those receipts, and then let's say like in 30 years, when you want to actually access the money, you can submit those receipts. There isn't any limitation at the moment in terms of, when you have to actually submit the receipts. So, if for some reason you get older and you don't have a lot of health issues and you just want to take that money out, then you can take it out, but you would pay tax on it just like you would with the pre-tax IRA, just whatever your ordinary rate is at that time.
Okay, yeah. And then Jade, before, and I'm going back to the questions before, but this just relates to what we were just talking about. Does the health FSA, and this would actually be, I think you mean HSA, have to be offered by your W-2 employer? And the answer is yes. It has to be a high deductible plan offered by your employer, correct?
Correct. Yeah. So whatever your health insurance is, yeah, it has to be high deductible. I think for this year, it's I want to say it's like $2,700 for a family. If you Google, HSA, high deductible plan limits, IRS limits, it'll show you, but usually it's like about $2,700 for family plan, and like you can't have more than $13,000 or so of out-of-pocket expenses. It changes every single year with inflation.
Yeah. And then the FSA, that's a flexible savings account, but that's not tax advantaged in the same way. So that's a different thing than the HSA, just to clarify that question. Okay, so then Rodolfo, I'm going back here, had a great question. How can you offset W-2 income using real estate, which is like one of my favorite things. So I'll let you kind of give the primer on that.
Yeah. Well, that's definitely real estate is a big topic in terms of education for physicians, because a lot of you are bombarded with like, hey, get into real estate and have things covered and you can take all these deductions and credits and blah blah blah. Well, the problem is that you have to actually be considered a real estate professional in order to take those losses. So in a normal situation, since you guys end up making too much money, those losses that occur from like depreciation or any other expenses that for that rental are passive losses. And that's because you're not active in the business. And that's how the IRS normally treats rental properties. And so those losses, you don't lose them. They just get carried forward until you either have passive income to put against it, or you sell the property. So what some professionals can do, what some taxpayers can do is qualify for real estate professional status. And that doesn't necessarily mean you have to go out and get like your real estate license. What that means is you have to be spending more than 50% of your time doing real estate activities, and you have to be spending about 750 hours a year doing those real estate activities. So there's a huge hurdle you have to jump. And if you're a full-time employee, it's very difficult to do. And so a lot of times if you have a spouse, that spouse can end up qualifying. Or if you are start looking at like short-term rentals, which are, as long as the average number of days of rent is about 7 days or less, then you can qualify those short-term rentals to be active, and then those can go against your income just like you would if you were a real estate professional.
Yeah, I think that's like really important to understand, because it's the real estate professional status that allows you to shelter the active W-2 income. And so that's how I take advantage of it, or I should say. But my wife, Selneed, she qualifies as a real estate professional. So that's how we were able to take those passive losses, count them against our active income, and save a lot of taxes. Like Alexis mentioned, it is deferred in the sense of when you sell the property, those taxes are recaptured unless you do a 1031 exchange, or unless you just keep it until you die and then you give it to your heirs, and then you get a step up in basis. But it is something that, if you're actively working, or if you're a full-time physician, it's it's pretty much impossible to meet those requirements. But investing in real estate, even without those tax benefits, is really great. So that's an excellent question. I think we have a few more about the HSA actually. So Esther asks, when you say the HSA grows tax-free, should we be selecting investing options within the HSA? And that would be, a yes. I would, yeah. I'll let you take it, Alexis.
Yeah, it just depends on what the HSA offers. So like my husband and I, we use Optimum Bank, and they have a whole bunch of different investment options. They have ETFs, they have, normal Coca-Cola sort of stock as well, and the mutual funds. And so, it's up to you to decide what you actually want to put it in. If you work with a financial advisor, they might be able to, or investment advisor, they might be able to provide that some additional guidance as well. So yeah, it just depends on what you want to put it in.
Yeah.
And what's
And then
available.
Jay asks, for the HSA, keeping receipts for 20 years and then reimbursing yourself through the HSA while allowing it to grow tax-free in investments. That's exactly what you're doing. So you're basically just keeping these receipts, and then just letting these investments grow. And then in the future, then you can pay off those receipts with it, essentially reimbursing yourself. Or, when you're older, healthcare is very expensive, more things come up,
Yeah.
you can use it to pay for that. And that's just like having that as your retirement money, that's saving you from needing to tap into your retirement money for those health expenses. Yeah, anything to add with that, Alexis?
No, you said it great.
This is Aaron, is there any benefit to creating a personal LLC as a W-2 plastic surgeon? I like it.
Nope, because there's no income that's being fed into it, basically. When you're W-2, it's you that as the individual that's hired, not you as your LLC. And the LLC isn't really, especially being physicians, is not providing any real extra liability protection. I mean, if you're negligent, you're going to be on the hook for it. And obviously I'm not an attorney and things differ from state to state, but just in general, that has been my experience.
Yeah, and I formed LLCs, for my real estate business and then for the blog business, but that's the only reason I did, not anything to do with my actual job as a physician. And we have Paul clarifying short-term rentals allow sheltering of W-2. This is, you mentioned this, Alexis, average stay of 7 days, and there's no hour requirement then. So that is a way that I've seen a lot of full-time physicians who have spouses that are either not interested in qualifying for real estate professional status or are also working as physicians or otherwise to shelter that active income. So that can be a great way as well. Short-term rentals just obviously being a little bit of a different animal than long-term rentals in terms of volatility and the involvement. But done well, I've seen it work really well. All right, Ryan is asking this is all you, Alexis. What about 401a or money purchase plans offered by employers? Good idea or bad idea since the contribution amount is fixed?
So you said, sorry, for 401a and
or money purchase plans that are offered by employers.
Got it. It depends on the type of plan, basically, and that's something that I would look at. What would be, how the tax would end up affecting you, and going from there. Basically, it's depends on the situation and what's offered.
Okay. Any other questions anyone has? And feel free, you can write them in the chat or feel free to just unmute yourself and just ask us. We're open to anything. I know this is a topic that is, on all of our minds and also pretty tricky and can seem intimidating. So let's see, Jay is asking, are you able to contribute to both your 401k with your employer and a solo 401k as a self-employment business? That's a great question.
Yeah, great question. So it depends on the type of retirement plan that you have and what your employer has. So if you are if you have a 401k with your employer and you have a solo 401k by yourself, you can't double dip on the employee E deferral, which is right now that 20,500, but you can on the profit sharing portion. So, but if you have, I had a little, where's my little cheat sheet here? Because, but if you have a 403B and a 401k, you can only do that, again, that employee contribution once. But if you have a 401A and a 401k, you can do both. You can do the employee contribution for both. And so that's at 20,500, you can double dip on that one. And if you have like a 457B and a 401k, you can double dip on both of that. And then if you have a 403B and a 457B, you can double dip on that as well. So it just depends on the combinations. But yeah, I mean, it can get confusing. And I even have like a little crib sheet that I keep on my computer to make sure I can always keep it straight.
Yeah, that's always a confusing one. I always get, I'm not necessarily in that situation, but it always confused.
Yeah.
And Jay's also asking, why is a SEP IRA not good? Which I guess it's one of the less favorable ones.
Yeah, the main reason in my opinion, is because for one, it precludes you from doing a tax-free backdoor Roth. And second, there's no employee deferral associated with the SEP. It's only employer contributions. And so with the SEP, you can only do that 20 to 25% of your profit or compensation. But with the 401k, you can do the 20,500 plus the 20 to 25% of profit or compensation. And obviously there's a little bit more to that calculation and such, but in general, that's the general rule.
Okay.
Yeah.
Jade has a question. Is there a way, and this is something they heard from another CPA, a way to reduce taxes as a W-2 earner renting cars on Turo, for example? This isn't something I'm familiar with. I don't know if you are.
No, renting cars on Turo. Are you like renting your own vehicle for someone to?
I'm pretty sure Turo is like a kind of one, like whatever, the ride sharing, but use your own car and
Like
have other
someone
people
uses
rent
your
it.
car?
Yeah,
Oh, okay. Okay.
I'm pretty sure. And Jade, feel free to jump on.
Use your own car in Turo, or you can have your own fleet of cars on Turo. And I guess you write off your car as a expense of the business.
Yeah. So I've never dealt with this sort of company before, but my best estimate on it would be that yes, you can write off the business portion. So if that car is being used 100% for that business, it's a business vehicle, it can be written off 100%. But if you're using it, any portion of it for personal, let's say you even use it 10, 15% for personal, then you can write off 90% of, it's like 10%, 90% of the expenses in that vehicle for, towards the business. And that other 10% is not being able to be written off because it's used personally.
Yeah,
Sense.
I was speaking to another accountant and we were just like scrambling for other options. And he just mentioned, like what you said, renting cars on Turo, 179 depreciating the car in your business. So kind of what you're talking about.
Yeah, I mean, in my opinion, I can see the IRS, coming back and saying, well, if you use that for part of your personal, work or not work, but, just driving around to like the grocery store, then they're not going to allow you to write off the entire thing. If it's de minimis, which is like, small amount of personal, that's one thing. Like, there's obviously people out there that, have fleets of cars and they'll take it to like McDonald's for lunch or something like that and then bring it back. That's considered, like I said, de minimis. But if it's your personal vehicle, then in my opinion, the IRS would see through it all if you try to write off the entire car.
That makes sense. Thank you.
Yeah.
And it's sort of going in that vein, can you talk a little bit about home office and you know, car sort of like mileage deductions and things like that for anyone, but like for a someone who owns their own practice, let's say, or works for a private practice. How can you use that? When is it okay to use that? When is it not?
Yep. So with your home office, you are allowed to take it. So it's just the business portion. So let's say a 1,000 square foot house and you use, 100 square feet of for business, then you can take 10% of the expenses associated with the house, like the depreciation and utilities, the security system, et cetera. And so property taxes, mortgage interest. And so if that's you're allowed to do that. And most of the time what my clients will do is they'll have their office in the home because they're using it for administrative purposes. So Jordan, like in your situation, you're going and doing all of your work in your home office for the prudent plastic surgeon. And so we're going to be taking it, because since you're using that for business purposes, we're going to go and take a portion of your home expenses based on that square footage of the home. And, even if you have, let's say that you're a physician and you have a side gig, doing like telemedicine, for example, or you do have your own private practice, but you have an office in your home that you do, you still read images in, or you do the books for the business at the house, then by all means, you can take that deduction. You just have to make sure, just like with anything, that you're properly documenting it. And then when you have that home office set up, you can count the mileage from that home office to the hospital, to, when you're doing between hospitals, or going to a clinic that's, way outside of town, you're allowed to go and write off that mileage as well. Same sort of concept. If you used your vehicle for 80% business, you can write off the tires, the maintenance, the car washes, the lease payments, the depreciation. If you fully own it, you can write off, actually the full purchase of the car too, depending on, whether you use it for 100% for business. So it really you just have to make sure you're keeping track of those things. And so then that way you can substantiate your deduction.
Yeah, that makes sense. Yeah, and then that would include, if you were, say you were working as a 1099 physician or whatever, that you could say, well, I go home, I have to do some charting and stuff, and I use this portion of my house for that. That could be included in that, correct?
Yeah, exactly. Yeah.
Okay. And then there's also a standard amount you can take, or a standard per square footage price, or you can kind of customize it. Can you talk about that a little bit?
Sure. So yeah, the IRS does offer a standard deduction for, the amount of square footage that you have. So I believe I think it's $5 a square foot. I don't use it that often, because even though it is easier, you don't have to keep receipts or anything, it tends to be substantially less than if you used actual expenses. But, if you're one of those people that you just dread keeping receipts, then that's an easy way for you to basically say, hey, I have 300 square foot, I have a 300 square foot office space. And so 300 times 5 is a $1,500 deduction. Okay.
And then within all that, we're talking about, the home office and the cars and everything like that. And W-2 physicians obviously cannot. I'm gonna put in the chat a blog post. It's just interesting because this is an option for people to consider, sort of forming your own LLC, your own practice that then the hospital contracts with. And essentially all you're doing is converting your income from W-2 in that situation to a 1099. You also have to do other things like you're using your own retirement accounts and things like that. But that is something you consider to take advantage of these tax benefits. They're not always available to W-2 physicians. So Next, we have celebrity Stelios Wilson, very famous New York City plastic surgeon who was also a co-resident of mine. Can you max out a 401k with a bonus, or does it need to come out of standard paycheck throughout the year?
So for an employer's 401k plan?
This would be like for a practice 401k plan, right, Stelios?
Correct. As a W-2 employee.
Got it. So yeah, you can, any funds that you receive from your employer, those can be used to max out the 401k, that they offer.
Thank you.
Yeah.
Great job, Jordo.
Thanks, Stevie. All right, Jade, I have a cash balance, money purchase, and profit sharing plan. Can I use a backdoor Roth on top of all that?
So sorry, repeat those three again.
It was cash balance,
Yeah.
money purchase, and
Yeah.
profit sharing plan.
Yep. Yeah. So you have to remember that this is how I like to remember is that it's an individual retirement account. It's not a business account. It's an individual retirement account. So as long as you have earned income, you can put money towards that individual retirement account, and it's completely separate from your business, or employer retirement accounts.
And then Jade is on top of it. I love it. Deducting home office doesn't apply to W-2 employees. Unfortunately, that's correct.
Yes, yeah, that went away in 2017. We used to be able to do it for unreimbursed business expenses. And that was itemized deductions subject to 2% of your adjusted gross income, but that has been eliminated, unfortunately. So one thing that W-2 employees can consider is trying to renegotiate some of their contract, even if for let's say you have call money and you're able to separate that call money to be paid 1099, then you're able to take advantage of a whole bunch of other strategies and writing things off that you wouldn't be able to as a W-2 employee.
Okay. And then a question from Amy to Guy. This is a good one. What do you find to be more beneficial in most cases for writing off a vehicle, the actual expenses or the mileage? And then there's a part two, but I'll let you answer that first.
Sure. So the actual. Now you still have to go and keep track of the mileage. So what I do is I say, hey, taxpayer, keep track of your mileage. You have to keep track of your total mileage and your business mileage so you can get that business percentage. And then you want to keep track of all of your actual. And then at the end of the year, you look and see, okay, which one's going to be more beneficial. And I don't think I've ever seen the standard deduction be more beneficial than the actual expenses.
And then the second part of that is, can you speak about this being the last year for 100% depreciation on vehicles over 6,000 pounds?
Sure. Yeah, I mean, that's what it looks like currently. I mean, it could get extended. But there's not much to say other than that. It's something that's going to end up going away at the end of this year, and it's tearing down.
Okay. Yeah, and I should mention too, for the real estate professional status and the being able to take advantage of bonus depreciation with real estate, that's something that's phasing out, I think, in 2026 completely. But this is the last year of being able to use 100% depreciation, and then every year it's going down after that. So something to keep in mind. Esther with a great question. Can you please recap the benefits, if any, of having a side gig as a W-2 employee if your goal is to decrease tax burden? Does the additional income hurt me as I try to decrease my gross income by maxing out retirement accounts, etc.? How would I shelter that additional income? Because our goal is to take advantage of public service loan forgiveness. So that's a really good question, because you're like, well, if I make more, then I'm just going to get taxed more, etc. So I'll let you take off on that.
Yeah, it's a very loaded question. On our website on cerebraltaxadvisors.com, we have some case studies that show the benefits of, if you're just a W-2 employee, but then you have this side gig, you're able to take advantage of setting up like your own S Corp and going in, creating a retirement plan as well. And by basically being able to use your W-2 wages as pre-tax deductions in your business, you're able to create losses, and that helps to lower your taxable income overall.
Yeah, and that's, again, a lot where having a tax advisor is so helpful. And, for me, when I was just simply a W-2 physician, I started out doing my taxes myself. And again, as things got more complicated and I did have a side gig, I was concerned about these things and also wondering sort of where that sweet spot is. And that's where Alexis has been able to help a ton. I can say for sure that having the side gig has helped both in terms of increasing my income and sheltering taxes, both on the real estate side and the non-real estate side, because of a lot of the strategies that Alexis has designed for us. For Jay here, question: I don't understand the merits of a backdoor Roth. If one assumes that they'll be paying lower taxes in old age, then wouldn't it make more sense to not pay taxes now at a high rate as a high income earner and pay it later in a lower bracket?
Yeah, great question. So with most physicians, you guys are piling money into retirement, and that is all pre-tax. And once you, right, as of the moment, once you hit age 72, you're required to take out distributions from your retirement. And, if you've amassed, $5-10 million, I mean, those can end up being in like the $200,000-$300,000 per year range in terms of those RMDs. So, your once you've hit that age 72, your taxable, your tax rate might shoot up because of those RMDs. Now, then everyone's like, well, I'll just do Roth. I'll just do everything Roth. Well, that's why with, first off, you should be maxing out your pre-tax deductions, and you're not required to do your backdoor Roth. But if you have that additional cash flow and you're paying tax on it right now anyway, might as well put that $6,000 into a tax deferred account, let it grow, and then you can get that money out tax-free when you want it. If you don't want it, it goes to your heirs tax-free. So, it's kind of one of those things. You really should be doing it if you have the extra cash flow, because like I said, you already paid tax on that $6,000. Why not just let it keep growing tax-free and have to pay tax on it again?
Yeah, that's how because I sort of, when I was starting out, like, was thinking the same thing. Well, what's the huge benefit here, and trying to figure out, where I was going to put my savings and things like that. And it's basically just one of those things. It's like, well, I'm either going to get taxed twice or I'm going to get taxed once. I guess this lets me just get taxed once, so I might as well take advantage.
Yeah. And remember too that even if your spouse doesn't work, just by the fact that you work, they can also contribute to their IRA as well, either traditional or Roth. But remember, if you're making too much, then they have to do the backdoor Roth as well.
Mm-hmm.
Yeah.
And John asked the question that I think everyone wishes we could know somehow, but do you think tax rates will be higher in the future to pay for all the government programs and debt and deficit and everything?
Yeah, if I had a crystal ball,
What's your hot take?
Yeah, exactly. So financial advisors are very much under the I guess impression or opinion that tax rates are going to go sky high and everything needs to be Roth and et cetera. For me, just looking at since 1986, when we had a really large basically overhaul of the code, tax rates really have stayed within kind of this like, 3 to 5% bubble. And so, I really think that if things got terribly higher, there would be a lot of pushback from, the US citizens. So whether or not, it's actually going to stay put or, stay within that bubble, obviously I don't know for sure, but, I believe that we're going to be staying about the same general amount, and we're not going to be back in the same sort of situation as like in the 70s, where things were sometimes getting up into the 90% range.
Yeah. I tend to think similarly, but that's also I hope.
Yeah.
Amy has another question. Recently, I started practicing 100% as 1099 independent contractor, and she's in the
Congrats.
process of setting up a PC. However, she's had conflicting advice on forming a PLLC instead in order to avoid being taxed as a corporation. What's your advice for people kind of going through this process?
What state are you in?
I can answer that. New York.
New York. Okay, fair enough. Is she in New York City?
No, I just know it's because she's her husband.
Okay, great. So yeah, a lot of it really, it depends sometimes on the state, sometimes on the city. So like in New York City, they're a lot like Tennessee. They tax S corps just like they do C corps, and so it's not. You lose the federal benefit basically. And so when it comes to PLLC versus doing a PC, and it depends on the type of entity that you want to be. The LLC gives the most flexibility because you can be a sole proprietorship, an S corp, or a C corp or partnership with any of those. But when you're a PC, you're either taxed as a C corp or an S corp. So if you're going and also too, I should back up a second. They also can have different fees. So sometimes in some states, and I can't remember for New York off the top of my head, despite living there for 7 years. Well, my husband did his residency. Usually the PC tends to be more expensive than the LLC. And so you might want to be able to save some money there by doing the LLC. But if I have a choice when setting up entities for my clients, I usually choose the LLC, just because if for some reason down the road you start to slow down and the S corp, let's say we're doing an S corp isn't beneficial, then it's much easier to revoke that S corp election and then be treated as a sole proprietorship, versus then you'd have to be treated as a C corp if you're a PC. So again, it kind of depends on your situation and your goals. And I mean, if you're, developing a practice where you're planning to bring on partners, then a PC might be a better option for you.
Thank you.
Yeah.
And then this is a good question as we kind of reach the end here. But so Sarah is asking, if we are going to invest in real estate, is it better to have an established company like an LLC formalized prior to buying the investment property, or can that company be formed after the property is purchased for tax benefits? I can tell you what Selenide, my wife, and I did. We buy small multifamily. So if you're buying properties that are less than 4 units, you can buy in your own name. If it's above 4 units, you don't have a choice. It has to be a company or an LLC that you form to buy it. But we just buy in our own name because you can get more favorable interest rates, and it's easier to work with banks and things like that when you're just doing it yourself. And then we have an LLC that we formed, but we formed it like after we bought our first properties. We still have it. We choose to just have one LLC that we put all our properties in, but we just quit claim. That's the name of the process, quit claim. We quit claim the properties from our name into our LLC names, within the same tax year that we buy it, so that we can take advantage of the tax benefits. Say that again. Sorry, it was just a little muffled. Or was that? I don't know if that was just background.
I think it was background noise.
Okay. All right, we have two more questions we'll get in. John asking, what do you look at to defer or avoid capital gains taxes on the sale of highly appreciated assets? I think you asked that earlier and I forgot to read it. So thanks for putting that in again, John.
Yeah, so there's different options. So and it depends on the type of asset. If it's real estate, then you can look at 1031 exchanges, which is basically you take that gain and you move it over to the next property. And there's a whole bunch of rules involved with that, and like the the amount of gain that you have to the amount of proceeds that you have to put all of that into the next property, etc. So there's some limitations on it. But there's also other things like opportunity funds as well. And these are, I'm not going to get into that on this, but they're because they're extremely complicated. But essentially it allows you to defer that gain for, in this case, it's, I think through 2026, I want to say. And there's potential that they're actually going to extend it further to 2028. And then, you can have a large portion of that capital gain actually come out tax-free as well. So, and then if you are very charitable, there are things like charitable trusts that you can do. And, again, those can get quite complicated as well. And there could be a bit of expensive as well because you have to set up the trust with an attorney. But one thing I always like to remember, especially when it comes to, capital gain deferrals or even retirement contributions, et cetera, at some point you got to pay the piper. And, it just depends on when and what your tax rate is. And that's where you look to take advantage of that tax arbitrage.
All right. And then I think we have our last question we'll kind of finish on from Ricky. Question on 199A deduction. He has 1099 side gig income that involves interpreting EMGs. No direct patient care involved. Can he still qualify for the 199A deduction, or is it a specified service and excluded?
It's so it's a specified service, and it just depends it depends on how much he makes, whether or not it's excluded. And so the general rules, it's about 400,000. And so if you make more than 400,000, then you start to lose that 199A deduction. But that's where crafty tax planning comes involved, where you try to have different deductions or credits and such that can help lower your taxable income to allow you to take advantage of that 199A deduction.
Fantastic. So yeah, well, I think that brings us to the end of our hour. I really want to thank everyone for joining us and spending your time. And Alexis, thank you for sharing your wisdom and giving us your time as well. What is the best way for people who are interested to reach out to you? And again, I don't say this lightly, Alexis has been amazing for us tonight. So I give her my highest recommendation for anyone looking to improve their tax situation.
Thank you. I really appreciate that. Yeah, if anybody wants to chat with me, you can go to our website, just to cerebraltaxadvisors.com. I put a ton of information on there, very transparent. Our pricing is on there. And our ROI guarantee as well is on there. And you can go just to our contact page and you just go through a little questionnaire to make sure that we'd be a good fit. And if all looks well, then you're able to just look at my calendar and find a time that works for you. And then we'll have a little, what I call discovery session to get to know each other and really make sure that I can help you out and give you a little bit of insight as well into your situation.
Awesome. Well, thanks so much again. And everyone, this is recorded, although I got a little bit of a late start on it. So I'll make sure I'll send that out to all of you as well, so you can refer back. So yeah, everyone have a great night.
Great. Thank you so much, guys. Good night.